From the morning reading, global stocks start week on a strong note. Important support levels for emerging and developing foreign markets continue to hold. Same is true for U.S. stock indices, which are up sharply. Stock indices approach test of the 50-day lines. The VIX drops below 20. The fact that the rally is taking place during October is also encouraging. Emerging markets lead the global rally. Stocks around the world are continuing the rally that began Friday after a very weak U.S. jobs report. Part of the reason for the renewed optimism may be the belief that the weak job report took the Fed rate hike off the table for this year. That also weakened the dollar and boosted commodities like copper and energy. Energy and materials are among the strongest sectors in a strong market. Stronger commodities are also boosting countries like export commodities and emerging markets in particular. That includes Brazil and Russia, and although mainland Chinese stocks are closed until Thursday, Hong Kong stocks are having a strong day. That's helping commodities as well, and risk assets in general. That includes developed stock markets in Asia and Europe. It remains to be seen if the October rally is enough to overcome overhead resistance barriers and moving average lines. It's important, however, to review where this rally started from. The weekly bars show EEM bouncing off important support formed at the 2011 low. If emerging markets are going to make a turn for the better, this is precisely where it should begin. It's also encouraging that the 14-week RSI line is rising from the most oversold reading since the end of 2008. Emerging markets have been the world's weakest link. Any improvement there would have a positive influence everywhere else. Foreign developed stocks are also bouncing off important support levels. The weekly bars show EFA bouncing off two important support lines. The first is the rising trend line drawn under its 2009 to 2012 lows. The second is a flat line drawn over its 2011 peak. There again, if that index is going to turn back up again, this is precisely where it needs to do that. It's getting help from its 14-week RSI line, which has bounced twice off its oversold line at 30. Europe and Japan are two of the day's EAFE leaders. Europeans have seen gains close to 3%. Australian stocks are also rallying on the back of commodity gains. The S&P 500 nears its 50-day line, climbing sharply today after a successful retest of its August low. It appears to be heading for a test of a falling 50-day average and possibly its mid-September peak of 2020. It will have to clear both barriers to turn its trend back up. The twin August-September lows on the SPX remaining well above the previous October low. Seasonal trends start to turn more favorable for stocks during the fourth quarter. The fact that so many oversold global stock markets are bouncing off important support levels at the same time suggests that the worst may be over. It may take some time, however, to repair the technical damage that was done over the summer. But a new basing process may have started. And the VIX drops below 20. The VIX index falling back below the 20 level today and its 50-day average. A close below the 20 level would move the VIX out of the danger area for stocks. That's another sign that option traders don't need much need for a point to hedge against a possible stock market drop. And then also, buyers stepped up over the past week, pushing the S&P to its largest 5-day gain in over a year. There have been other times that such buying pressure showed up after stocks tested a prior low, leading to mostly positive returns, but not a conclusive idea that stocks have bottomed. After a 4% rally on Friday, the S&P energy sector picked up right where it left off and surged another 3% today. This two-day rally has left the sector back above its 50-day moving average, breaking a streak of 92 trading days below the 50-day moving average. The streak of 92 trading days below the 50-day moving average that the energy sector just broke was actually the second longest streak of its kind over the past 25 years. So now that the sector has moved back above its 50-day moving average trend line, has a bottom finally been made in that sector? Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:11 a.m. Central Time, and I'm recording this in preparation for the market day of October the 6th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, quite a bit of content in the morning reading today. I hope you found that useful. Let's go ahead and dive into our morning report. In general, a bit of weakness, and after the successive very bullish days in the SPX, we've gone like 100 points from bottom to top. It only makes sense that we might have some weakness come back. It's not pronounced weakness, and by the time we open, this could even be gone. But the S&P right now is down about 1/4%. The Russell about the same. NASDAQ down about 1/3%, and the Dow down about 0.18. Crude oil down about 2/3%. Euro up about 1/3%. Bonds up fractionally, as is gold is essentially scratch. China here, and I think I read it off yesterday, but actually the China market is closed, so this is as of 9:30. They will apparently reopen on Thursday. Hong Kong, though, was open, and it was at this time the cut was just essentially scratch. Japan up about 1%. Germany up about 1/3%. United Kingdom essentially scratch. In terms of macroeconomic reports for today, you have trade balance, and that'll be pre-market. And you have FOMC member Williams speaking. That seems to be about it of major note for the U.S. today. In terms of tomorrow, you have crude oil inventories, of course, a 10-year bond auction. If you're doing bonds, that could give you a little blip in the middle of the action. And that looks to be about it of note. In terms of our current volatility conditions, obviously we continue to ebb off. Indeed, the short-term VIX is down below a 20 now. But notice here that the skew has started to rise, and we'll give you another piece of information about that on the next sheet. Though the IV percentiles, look at this, all in the lower third, so a lot of the volatility has ebbed off. Another standard deviation move put in by all four broad market indices yesterday, and the Russell was up 2 standard deviations. So pretty bullish action here of late. And you notice not only were we like 5 days in a row straight up, but those were on the S&P, at least 3 out of the last 4 days were standard deviation moves to the upside. So very unusual for that much energy and momentum to come in on a up move and for it to be so progressive. Let's go ahead and take a look at some of these charts. So here's the SPX, and you see this, what we're talking about. So we come down, we retest the area of the August lows and have our classic reversal pattern here. You look at the 3-candle reversal pattern with confirmation, and then it is 1, 2, 3, 4, 5 straight up, and we have busted through the important resistance area right here. In fact, we gapped over that. That's a classic way to get through a resistance area, have the professionals do it in the overnight action. And then the cash market just has to kind of follow on, but it did better than just follow on. It certainly added to that yesterday. Now the next area of significant resistance is going to be the round number, and this is other than this like 1 hour of price action from the post FOMC announcement, which was reversed. The prior resistance was right here in this 1995-2000 on the SPX area. So that will certainly be an important, very important area of resistance right across the tops there. And then I would put also resistance at the top where the bears took over from the FOMC and started this whole move down as a line of resistance. So we got 2 fairly close proximity lines of resistance in the area. And this is likely to give some pause at least, if not some stalling and range bound action that could take place between this area here and the area of the lows. Perhaps could stay in the upper half of that area. We could see some stalling action and pause action in this area. That's just one theory, of course. Other theory is that the bulls continue to show strong momentum and basically start putting more and more pressure on the shorts. If you were short during this action, a lot of people were probably busted out of their stops here and certainly here. But if you are a big time trend short, certainly we start pushing through these levels, and that could really put enormous amount of pressure on anybody that's been short ever since we broke down out of the prior range, which we spent many weeks in back here in this area. So the shorts are starting to run out of play area in which to be positive, and assuming that they went short in this area. So if they haven't already covered, we would likely see the last of them covering in the next few points. That short covering action could propel it up through these resistance areas and bring us back into the former range. So we'll see where that goes. It's hard to believe that we go straight there after such a move. Russell, of course, had a 2 standard deviation move yesterday. It was relatively weaker, and you see where it undercut the August lows by a pretty significant amount. And it's coming into its own areas of resistance at this point. We need the Russell to participate if we are going to have a significant bull trend, as do we need the NASDAQ. And the NASDAQ, of course, also broke through this prior resistance area and now has the next swing high from the FOMC report area to deal with as well. So in many ways, some similarities to the Dow and the SPX. And here's the Dow, and you see it's already up and close above this prior resistance area, so it just has the FOMC as its next area of resistance, and I call it the FOMC wick here. This action right here took place in that first hour after the FOMC report before the bears took over. So in relative terms, the Dow is stronger than the SPX, so that should be enough on that. Let's take one more. Let's take a look at the VIX futures, and you see here we're playing right around that 20 area. This, of course, is live with the VIX futures. So we'd like to see if this is truly going to be the bulls hold. We need to see this break below this area here into the below 20 area and come back down into the 18 and 16, kind of the, in quotes, more normal volatility ranges, which is the area in which the bulls live. In terms of a regular daily report, we still have some mixed signals on the portfolio investor posture. Obviously, IBD has already gone to confirmed uptrend. Accumulation distribution, the S&P chart is now a C+, a NASDAQ still remains an E. GMI index remains a 1 out of 6 with a sell signal, and that author in cash, and the primary market condition still remains strong bear. Decision points have not changed. We've still got lots of down arrows, and then on the intermediate term market posture, we are weakly bullish. So when you put all the consensus of that together, we're kind of in transition is probably the best way to put this. You have trend, and then you have transition, and of course at that point the trend can either continue or it can have a reversal and start a new trend. And of course our prior trend was one of bearish action, and now we seem to be in transition, and the question remains is do we establish a new trend? And you heard all that material from the morning reading, and several authors there espousing that we have bounced off very important support lines in multiple markets, including developed markets, emerging markets, the energy sector, the broad market S&P. So, some very, very important inflection points coming together. And that makes for the strongest kinds of support when you have confluence across multiple markets, multiple reasons for various traders and investors to be buying. And all that coming together serves up this kind of momentum that we're seeing. So, bottom line, portfolio investment posture is in transition. We have to see where that follows through. In terms of position sizing opinion, portfolio is up to 100%. I would exercise some caution there, given that we are in transition, and then kind of put that in context. And then from a VIX-based, volatility-based, active trader position sizing opinion, up to 75%. Intermediate term market posture, weekly bullish. You see the S&P had quite a pop yesterday, all the way up to a 33.3. The Dow outright bullish at this point, up over 50. NASDAQ is right on the threshold of going outright bullish as well. And the Russell came out of the bear camp and joined the weekly bullish at the 23.7 level. So an improvement across all four broad market indices in the intermediate term market postures. Hedge warning status remains level 1. We are certainly not all clear, all go all the time, with which would be a level 0. There are still elevated risk conditions, so a cautionary approach. Put in some positions, but don't necessarily go full position, and don't go a lot of new positions until you see more confirmation in us breaking through these additional lines of resistance. But add to your positions as we kind of accomplish those stages. In the individual metrics, volatility base, you see mostly okay here. Still got the VIX over an 18. That's one warning area. You have a skew up over 130 yesterday, and what that means is there's a 10% probability of a 2 standard deviation move within the next 30 days. And the study behind this actually couched this as the next 30 days. That's important to note. This is not an acute metric, but in observation, I found that usually you see this 2 standard deviation move. If it's going to happen, happens within a few days, maybe even 1, 2, 3 days of that rating. So right now the rating is up over 130. That does set us up for a warning sign that we could have a significant move, in the foreseeable future. Now 10% is not huge, but compared to the normal market, that's a significant elevation. And remember, this is all about the assessment of risk, and there's been a significant elevation in risk as per this signal, and that we could have a 2 standard deviation move in the next few days. And current expected move in the SPX for the current week is a 32. That's definitely been subsiding. If you look back in the last 4 weeks, we had ratings much higher than 32 on the market maker move. Oh, this was also of interest. New York Stock Exchange, new month, 1 month, new high, new low, 469 new highs. This has been the best reading I have seen in some time. Even when we were making some of these previous bullish days, we are still seeing significant number of new lows and not a lot of participation making those new highs. We've been complaining about a weak breadth across both the NASDAQ and the S&P. So this was a most welcome sign that this was actually being supported by a large number or larger number of stocks. Intermarket risk aversion indicators, 1 has now flagged as risk on, but do note that we still have 4 as risk off. So that's just another reason to be cautious about this current move. In special opinions, VIX is outside the acceptable window for novice traders to initiate new positions, but aggressive traders you will want to take advantage of this elevated premium that's still present. Consider reduced position size and potential for higher than normal delta and vega moves. Covered calls, I put on 3 positions yesterday, cautiously bullish, acceptable to initiate new positions for novice traders using a 1-to-1 ratio of in the money and out of the money. And indeed, on 2 of my positions, I did just that. Half the position is in the money strikes, half the position is out of the money strikes. Did go with 1 position all out of the money, but that was due to an impending dividend. I wanted to make sure to capture that dividend and not have any of my strikes in the money. So there was a reason for that. Consider reduced position size, legging into covered calls through well out of the money, put selling. And indeed, we have earnings season, so if some of your favorite stocks are coming up on earnings, sometimes you can use, if there's a miss, to jump on that, to sell puts on that energy of the miss, and then if it continues to show weakness, then you then can take assignment and then convert that into covered calls. And having done all that on a greatly discounted entry from where you might have gone in otherwise. So kind of consider the opportunities that might present themselves coming forward. And indeed, with respect to put selling in general, cautiously bullish, acceptable for new core put portfolio position. Consider reduced size and well out of the money puts. Defined risk spreads could also be helpful in this kind of a market, and even aggressive traders should consider scaling into full positions. Terms of sector Pacific, obviously a lot of healing here. This is a lot more green than we had 3-4 trading days ago. And then percent change, a sea of green here. Look at this. Industrials, energy up almost 3%, materials up well over 2.5%, and you see it's even positive through the 5-day and 1 month at this point. And some sectors even show positive, for a 3-month period. So that takes you back, quite a period through some of this weakness, including all the August weakness. So much more encouraging kind of numbers that we're seeing at this time. Okay, this was a lot of materials for today. We went a lot longer than we usually do, but we're seeing some really significant things happen in some of the recent days, and as a result had more material wanted to share with you. I hope you find that this is useful to you, and as a result, and remember, this is free. Their cost to you is that you reward me, and you can reward me by doing retweets to your Twitter followers, to your StockTwit followers, following me on YouTube, by subscribing to the channel, and of course liking me. I take note of every one of those, and that is my reward to continue to put this energy and effort into this work and to share that with you. So greatly appreciate you doing that. Also remember, we do have this course announcement in collaboration with the Chicago Northwest Burb Trading Club. 40-hour course, 10 weeks, 4 hours each session, actually a total 43 hours of educational material. The 9th time this has been taught by our friend Nick Fosco. It is to cover topics of self-directed investors and those seeking to trade for a living. Course starts this Saturday and will run 9 to 1 each day in the Chicago suburb of Schaumburg. It will be simulcast to the web for those that are not in the Schaumburg area, so no worries there. You can participate. Greater details about course description and sign up and all that kind of stuff can be found at this site. Disclaimers as always, hit the pause button if you need more time to review this, and we will see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.